Welcome everyone. Matthew Piepenburg and myself, we are back. We're back in our MAMChat. It has been a while. I managed to have a bit of COVID in between, which was surprising. I avoided it for a long time, and sadly, I did take 2 injections. But as we knew, that wouldn't help, or certainly. But anyway, it was a mild COVID. So. I'm back in almost full shape now, and a lot is happening in the meantime, Matt. The markets are collapsing, and virtually every single asset market is collapsing. And on top of that, we have a macro situation which is awful, and we are already seeing the beginning of this. And then, of course, we have the geopolitical situation, which is unpredictable and uncontrollable, and that will clearly lead to major problems in the world in coming years, because this is not a short-term war, in my view. It's going to, it's kept at the level where world powers don't have to put in major resources yet, fortunately, and therefore it's rather going to be a long war than a quick one, I believe. Yeah. So, Matt, let's talk about the situation now in the markets and the macro world, and obviously, as always, you have some views about that.
Yeah, well, obviously, I mean, I definitely want to get your views on this, on the macros, because these are the worst macros I've ever seen in my career. And there's a lot to be going and a lot to be discussing going forward on that. I want to get your thoughts on that in particular. I certainly can speak to risk assets as my background in stocks and bonds prior to really understanding commodities. It's certainly fascinating for me as a former kind of hedge funder to be looking at these tapes right now. And of course, as of the time of this conversation today, we're looking at bear territory for the Dow, the NASDAQ, and the S&P. I mean, the S&P has slid past -20. The NASDAQ is brutal at -30, -30% plus, and even the Dow is well below its 30,000 range. And as far as I'm concerned, the things that I look at, this is just the beginning. Based on Shiller PE multiples, or even nominal PE multiples, we have a long way to go to get even near fair value in the S&P, as an example. It could easily go down another 15-20% from where we saw it in March of 2020. So I'm not optimistic about the stock market as we tighten into a debt bubble. Again, notwithstanding a sudden pivot anytime soon, these stocks still have a long way to go down. So on the purely equity pillar of my looking at these markets, the stocks look pretty bad. On the credit side, what we call fixed income in the US, or in English, I think it's nixed income or no income. There's really no income in the bond market. Even the small sliver of the bond market is known as investment grade, has very little issuance and very little power to it. And adjusted for inflation, there aren't any bonds right now, sovereign to junk, that are giving you a return. There's a big jump in credit default swaps for junk bonds. In other words, a big demand now for insurance on junk bonds, which is just another really scary kind of 2008 sign of lack of trust in the bond market. As we've written and I've talked about recently, the mortgage-backed security, that toxic waste that never goes away, that hot potato from 2008 that we still can't seem to get rid of. We've parked it at the Fed for many years. Yeah. The Fed is now, of course, trying to unload some of that. The only ones that'll take it are the commercial banks, and they'll do so at a discount that pushes rates up in MBS market before they sift through Fannie and Freddie to get turned into more syndicated asset-backed securities, which are just more toxic waste. Net, though, all that means is mortgage rates are going to go up as yields go up on the MBS. And just, in the last 6 weeks, mortgage rates on the 30-year fixed in the US have gone from 3% to 5% to 6%. So that's going to put a real headwind in the real estate markets in general, commercial real estate included. So, in those classic asset classes of, stocks, bonds, and property, we're seeing a lot of pain. And again, I don't think it's anywhere near its lows yet. We're just seeing this. And again, this was something you and I were talking about, Egon, at the end of last year, into this year, that they're going to be tightening into a debt crisis. It's going to create a tantrum in the markets. This is not a surprise. And I also said, and we also talked about at the end of last year and into this year, that, look, even with this tightening, this quantitative tightening, this new approach by Powell and the Fed, that even if they tighten instead of ease, they're still going to use swaps in the money markets and swaps in the reverse repo markets to provide liquidity for the bond market. So notwithstanding all the headlines of raising rates and tightening the balance sheet, you're seeing absolutely astronomical intervention by the Fed in the reverse repo markets. And I think it's important for people, understandably, who don't follow all these kind of esoteric corners of the U.S. debt market. The reverse repo market is essentially providing grease or liquidity to the money markets and to interbank loans, and it is completely dried up to the point where, as of this year, the Fed is providing daily loans to the money market funds of $2 trillion a day. That's simply unfathomable. I've never seen anything like that. So you and I have always said, boy, that 2019 repo crisis got ignored by the headlines. I don't think a lot of investors realize what's going on right now in the reverse repo markets. That type of Fed support is absolutely extraordinary. So really not a lot of safe havens, a lot of safe places to hide in this current crisis. I've been looking at commodities, which is a little bit more positive. Obviously, commodities go in cycles like everything else. We saw that in 73, 1990, 2008. And as this graph on the Bloomberg Commodity Index indicates, commodities are doing very well this year relative to other assets, but they're not nearly as high as they were in 2011 and prior. So I think the commodity super cycle has a lot way still to go. So that is a positive note. Of course, precious metals are part of the commodity discussion, even though they're monetary metals. Clearly, we have lots of opinions on gold. I think as I've written, as you see markets tanking at these kind of levels and continuing to tank, in the past, we saw that in October of 2008, and even March of 2020, that for the first small chapters of those market crashes in stocks, gold can be sympathetic and fall with asset classes because of needs for liquidity, margin, et cetera. But typically within a short period of time, gold diverges from falling stocks and starts to rip to the north. And I think that's what we're seeing. A lot of people, from Goldman Sachs to us to the average investor, would like to see gold priced higher right now. I'm not worried. We're not worried about the ultimate direction of gold or the timing of that. I think it's important to note, though, when people are disappointed that gold isn't at 2,500 yet, that we should be very glad that it's certainly not falling 30% like the NASDAQ, or certainly like Bitcoin. As the chart on Bitcoin shows, it's an absolute disaster this year to date. So, gold is holding its own as a non-fragile asset. But I'm very, very curious to know, besides all these things in these markets, Egon, let's just step back and look at 30,000 feet. The mess, inflation, the Fed tightening into the highest debt levels in history. The war continues, geopolitical risk, the central bankers blaming everything on COVID in the past, now Putin in the present. What do you make of this mess? Can they really contain inflation with more rising rates? Can they afford it? What options are left? What's your outlook at the macro level right now, Egon?
Well, Matt, there are two sides to this story, and I worry about both. One is, of course, which you talk primarily about, which is the professional side, if you want, the investment side. Every single market is down, as you said. Obviously the high yield bonds, the S&Ps, Bitcoin is down, or 70% on average. Cryptocurrencies are down 90% from the high, and you have the real estate indices are down, etc. So, of course, for professional investors, when I speak to a lot of especially my friends who are investing, and markets have been kind to a lot of people for decades, and therefore everybody expects this to be a temporary dip also. Of course, you and I believe differently, but in the meantime, most investors are sitting tight, and institutions, if they reduce the position, it's just marginally. And the selling we've seen is also on the margin, also very, very, there has been no mass liquidation whatsoever. So in our view, all the markets are down already around 20% on average. In our view, this is just the beginning. I mean, you think that it might go 15% under below the 21 lows. My long-term view is that this market is not going to finish until we're down 75 to 90%, certainly in real terms. I think this is going to be a major bear market. So on the investor side, which obviously will affect the whole world, because if asset markets go down by that extent, it's going to affect the banking world, the pension world, the insurance world, etc. But, I in our business, as you know, we are there to help people who want help, and people who have some assets to preserve. actually help them preserve those assets, because we are looking at here of not just for wealthy people, obviously, who will lose a lot of money, but you could say that they made a lot of money in the past 10 or 20 years or more. But we're looking at ordinary people here, and some of the facts that you stated, the facts talk about mortgage rates. I mean, as you say, they have in most countries doubled already. And okay, from very low levels, especially in Europe, it's been incredibly. You looked at 1% interest rate for 10-year loans, etc. But all of that is gone now. Everything is doubled, and most borrowers cannot afford a doubling of interest rates. And this is, in my view, just the beginning. I do repeat many times that I experienced a 21% mortgage rate in 1973-4 in the UK for a while, and no one could live with 10% today. And I think we will have 10%. I'm quite convinced that we will have at least 10% in interest rates, and maybe more. And of course, in an indebted world that we are looking at now, that most borrowers cannot afford that. So that's going to be disasters, obviously, on the commercial side, government side, but in particular for individuals. And that is, of course, a major concern. And then on top of that, we have what you mentioned also, we have the inflation situation. People are already, they can't afford the higher prices for commodities or food in particular for most people. And then, of course, for energy, whether it's petrol, gas, or in the US. I mean, so that it is a total disaster for the world also. And sadly, are the central banks going to do anything? No, they're going the other direction, as you rightly said, and that's going to continue. They will tighten more. They will increase interest rates. We're just the beginning of that cycle. And then in the end, at some point when the whole thing is has got so depressed, they will come in, and as usual, behind the curve. It's too late. And as both you and I agree, any money that they print now will have zero value, will have a very short-term effect. And of course, markets will go up temporarily, a big bounce before the next fall again. So we are looking at a situation here, which is, as I said, for the world, horrible, and for individuals, even worse. And of course, we're not even talking about the third world here, which already had a famine situation before the war between Russia and Ukraine, before the sanctions. And for them, it's that famine is just going to increase. But there will be food shortages in the West. So it's not a pleasant situation, Matt. And obviously, you and I talk about gold, and it's not going to save the world, gold. It's going to save the few who have a few pennies to put aside, and don't believe that you have to have hundreds of thousands or millions. Even if you have just hundreds or 1,000, I often point out that the people in Venezuela who did that 10 years or 12 years ago, or even 20 years ago, even because the dollar 20 years ago was parity with the Venezuela bolivar, and now of course it's gone to the sky, the bolivar, or fallen to the very well. It's worth nothing. And if you put a little bit in gold, then they would have saved you. So as I said, gold is not the solution to everything, but it will help everybody at whatever level they are. Obviously, if you have physical gold.
Yeah.
So Matt, I am concerned about the world. I'm not a pessimist. I'm not a negative person, but I do look at risk, and I think the risks in the world now are not just greater than ever been, but they are also unfathomable. Nobody understands the magnitude of these risks, and nobody understands the consequences. Of course, you and I don't either. We just know that the risks are major, and that the consequence of that is something that is going to be uncontrollable. Sadly, no central bank will be able to control it. They will lose total control. the World Economic Forum and Klaus Schwab and his motley crew, I think they're gonna people are gonna lose interest in them, and they'll lose their total power. So I'm not worried that they're gonna grab the world. So that's a pretty horrible background. But let's talk about something positive instead, Matt. We've written a book together, called Matters. Here we are.
Yeah,
Real solutions to surreal risk. This is not an easy, sensational read that says that gold is going to go to millions or hundreds of thousands, etc. This is a book to understand what actually what has happened to the world economy and why it's happened again. And since as we know, it always repeats itself or at least rhymes. And we are going to see something now again. And maybe you who made a major contribution to this book, maybe you will tell people a little bit about, summarize just quickly.
Yeah, real quickly. I mean, it is exactly what you said. It's often very difficult to discuss these things without sounding sensational or gloomy, but we're just trying to be as honest as we can about understanding gold. And one way to understand gold, whether you're a high net worth or you have a very low amount of income, you can still protect yourself. This is for all investor types, not just people that can afford to fly to Switzerland and put gold in the ground. It's important, though, to understand why gold. You have to understand the context in which gold is in the current times, but most importantly, or as importantly, in historical times. This is nothing new under the sun. This idea of every debt-drunk nation or regime eventually debases its currency and uses inflation to inflate away its debt, which crushes the little guy on the street and saves a few minorities in high positions. So what we're trying to say here is this is nothing new. And we spend the first half of the book talking about where we've come from, and in the next half of the book, what gold can do. And we're going all the way back centuries on this, but staying very modern as well. So it's a good primer for people who are still confused about precious metals and confused about the macros and confused about the markets. It's written in a way that I think even a novice can understand, but yet even an expert can agree with. And it put things in context without being so negative. And as you and I said, Egon, it's really the best things in life for free. As we start the book and end the book, it's our friends, it's our books, it's our music, it's our family, it's our connections that really matter. And we do mean that. And you even have an anecdote in your story about sitting to dinner with some wealthy friends in the Alps, and there's a Yugoslavian restaurant owner who shows up, and he had suffered inflation, but he kept a little bit of gold, and he escaped that disastrous 1990s Yugoslav inflation. So again, gold is not just for the fancy lads or the ultra high net worths. It's for everyone to think about. And I think this book is a chance to let them see that in a broader context. And I'm quite proud of it. I think we both put a lot of our true, honest opinions in here without trying to be sensational. And we're both tired of the gold bug bias. I think what we've tried to be, and have always been, is blunt and honest, like a good doctor with a real diagnosis. You've got to hear it like it is, and that's how we see it.
Yeah. And now, no one can forecast exactly what's going to happen now. We know, as I said, that risk is at a maximum. Everybody will do what they can to protect themselves and their family. It's a lot we can't do, but at the end of the day, as you rightly said, is all about helping other people. I think that's we can talk about markets and of course a lot of people are interested. At the end of the day, it all comes back to people and personal situations and families, etc. And that's what matters. Gold matters, but even in this situation, because it will help some people to protect themselves. But the family, the friends, etc., matter even more. And this is obviously what we will try to continue to navigate through these markets, and it'll be very, very difficult. People will be in shock. I'm absolutely convinced. But at the end of the day, we have to deal with the situation as it is, not the way we wish it to be. And people shouldn't believe that this is Putin's fault or this is anybody's fault. We are at the end of a cycle, and at the end of the cycle, everything happens that shouldn't happen. All the bad things happen. That it includes wars, that includes bankruptcies that include, misery for people and families. And sadly, that is part of the end of the cycle. And we will continue, Matt, to discuss that, and hopefully it will be helpful to some people. And so let's reunite again in a couple of weeks or so. Yeah,
sounds good.
In the meantime, bye everybody, and thank you, Matt. Thank you.
Thank you, Egon. Talk to you soon.